Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview senior executives by posing the exact questions I ask as part of Cove Street's diligence process. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you. This season of Compounders, The Anatomy of a Multibagger, is sponsored by Tegas. Tegas is an innovative and disruptive company that is changing the way professional investors work. For more information, please visit their site at tegas.co.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Mark Dankberg, the co-founder and executive chairman of Viasat. Viasat is a $3.8 billion market cap company that provides broadband and communication products and services worldwide. Viasat started off as a defense-oriented company, but has since layered on consumer and business-facing offerings by developing the world's leading high-throughput geostationary satellites. Over the next 2 years, Viasat will be launching 3 new satellites that will give the company the ability to offer global coverage to its military and in-flight Wi-Fi customers. Additionally, Viasat is rolling out community Wi-Fi initiatives to help people in emerging and frontier markets connect to the internet for the first time. All of this is happening while the company is facing a growing threat from low Earth orbit satellite providers such as Elon Musk's Starlink. Given how much is going on and the fact that Mark recently went from being the CEO to assume the executive chairman role, I thought it would be a perfect time to talk to him about the following topics: the future of the global satellite broadband industry, including competition with Starlink, what the U.S. military needs now from Viasat and how that may evolve over time, the cultural differences between the defense and commercial sides of the company, and how Viasat can benefit from all of the space-related activity going on right now. Before we begin, just a few disclosures to note. First, Cove Street owns Viasat shares. Second, Cove Street has done a number of podcasts and interviews specifically on our position in Viasat. Without any further ado, here's my conversation with Viasat co-founder and executive chairman, Mark Dankberg. As always, we will start this interview at a pivotal moment in the company's history. Viasat has a big moment every time a new satellite launches. But for me, the biggest change came with the purchase of WildBlue in 2009. And unless an investor goes back far enough into the company's history, he or she wouldn't understand that this company started in government and defense, and only really starting with the WildBlue deal has Viasat become more of a consumer and business-focused company. So what was the initial impetus for wanting to have a direct relationship with end customers, and what has that insight provided to the company as a whole?
Well, the main reason for going direct to customers was to understand them and to make sure that our value proposition was delivered to the customers as intended. And you can end up, when you go through intermediaries, where the intermediaries have, they have their own perspective, and it's not necessarily the same as the customers. And a lot of time, what they're trying to do is optimize around their own economics as opposed to the customers. And so we were in a position where the main innovation that we felt the market wanted was way more bandwidth for the money. It was pretty simple. And the intermediaries that we were going through were focused on other things that might bear eventually, but didn't really address the main thing. So that's how we got into it. And we had this discussion with them that was, hey, here's what your customers want. So here's how we can make what you want. And they didn't want that. They just didn't want it. They had other things, and so we were pretty convinced that was what the market wanted. And so that's how we started on Viasat 1. It was really about being able to deliver a lot more bandwidth per dollar for customers, and then to be able to ensure that that value proposition actually made it to the customers, to the market.
So as you were a company that went through intermediaries, I mean, there's a certain culture associated with that. Can you talk about how the culture and the sales organization and even technology has had to evolve as you've been, as you've developed those direct relationships with the customers?
Yeah. So, one of the most, I think one of the most important things, and I remember this pretty distinctly at the company, was we had, let's say we're working through a company, and we eventually acquired WildBlue, but we were working through them, and for a lot of our employees, they were the customer, right? Hey, what does the customer want? And in their case, it was, well, we want lower cost end user equipment. That's the big thing. And well, no, we think what your customers really want, because they don't see that, what they really want is more bandwidth. And so internally, we had this sort of conflict, which is, hey, are we going to work towards what our customer wants, or are we going to work towards something else? And I think the main point insight was, if you're going through distribution, there's this concept of sell through, right? Is that your distributor is really a proxy for the end market, but they're not the end market, right? So if there ends up being a divergence between your distribution and what the market wants, doing what the distribution wants is not a good strategy, right? That even though the market is not your direct customer, they really determine what's going to be successful or not. And so for us, actually, ironically, kind of the way we got that orientation was from being in the defense business, where in the defense business, you're always working through acquisition organizations. But one of the things we learned fairly early on was what a big divergence there was between the acquisition organizations and the end user organizations, and how to both recognize those things and to deal with them.
All right, that makes sense. And I'm interested in the sales organization side of that. So when you're selling through an intermediary, there's a certain sales culture, but when you're really focused on an end consumer, like that's a different sales culture. So I'm interested, like how you've thought about developing that sales organization on top of what you just described.
Yeah, and that's been a journey, partly because the selling mechanisms are evolving as well. So one of the things that we got when we acquired WildBlue was a sales organization, a consumer-facing sales organization, and they had two main components. One was wholesale, where they would sell through organizations like DirecTV or Dish or AT&T, and then they had a retail organization that would basically had a few things, some direct customer call centers, third-party call centers. And we, because we hadn't been in the consumer business, we were really oriented towards the wholesale ones, because think of that as sort of was more at scale, more like what we're used to. But like the first thing that happened was we ended up with divergence between the wholesalers and ourselves. So going back to this whole thing about speed and value, one of the things is that each of these other organizations were selling DSL. And so what they would say is, okay, well, look, we have a DSL product, we have a DSL price point. All we really want is a much lower price point. So make us a service at a low price point. And we'd say, well, that's kind of hard. What we can do is we can make a service at the same price point, but a way better value. And they'd say, oh, well, I'm not sure we need that, right? Because they can't adjust. We really want these two different value propositions. And it was pretty clear that, again, they were really looking for their portfolio as opposed to just what was going to be the best for the customer. So one of the ways we resolved that was we said, okay, we'll make the product you want, but because we have a retail arm, we can make the product that we think the market wants. Right. And we're happy to make you, here's the one that wholesale distribution wants, here's the one that our retail arm thinks. And the response they got back was, well, if you sell that, we can't sell your other one because yours is a better value. And we said, well, yes, exactly. That's the point. Right. So it was what that did is, it really highlighted this issue about the challenges in delivering a specific value proposition through distribution to a customer. And so that was really eye-opening for us about the value of having a retail distribution arm, even if it wasn't necessarily going to be the highest volume one, right? Because some of these other distribution channels, Dish and DirecTV at the time, they could handle very, very high volumes. But what we really got was a way to sort of gauge what the market wanted and to help those distribution arms deliver a service that I think was more in demand. And since then, there are these issues sort of crop up all the time. They're just natural. It's like, hey, once somebody gets into some form of distribution, they'll have incentives that diverge a little bit from yours. And so what's really important is just to understand what those are, try to find win-win solutions. But in general, what it's driven us towards is more and more direct interaction with the customers so that we can really gauge what's important to the market and then, reduce friction and deliver that value proposition. So now, we're really on a lot of things that others that are doing, online retail are doing, which is more personalization of offers, more more data-driven segmentation of the market, not just by things like demographics, but by the exact context of a particular customer, and trying to tailor products more and more specifically to them. And that's still a work in progress.
And we'll talk a lot more about that price versus value equation as we talk about the newer satellites as well. But so after buying WildBlue in 2009, the company went on to launch Viasat 1 in 2011, Viasat 2 in 2017. So I'm interested in what have you taken that worked well in Viasat 1 and Viasat 2 that has paved the way for the newest constellation, which is Viasat 3, which will be launching over the next couple of years. What have you learned, from both a technological perspective and, again, from a ability to actually sell bandwidth perspective?
Okay, so one thing that I think is really important is you want to have a strategy. You want to have some sense of what you're doing, and it's really good if you can reduce that to math, right? That if you can sort of bound and estimate and predict what's going to happen. And so the things that we were looking for instance, so remember, WildBlue had a satellite that was 7 gigabits per second. They spent close to $300 million on that. With Viasat 1, we got like 100 gigabits per second for roughly the same thing. So same amount of capital. So really the test was, and we thought this was going to be the obvious outcome, was, wow, this should be a way better value for customers. And the theory was not that we would have 10 times the customers at the same value proposition. It's that we would give the customers a better value proposition and have maybe 2 times the customers or something like that. So then the question was, okay, how can we tell if this is working? And we looked at things like what the demand was, what the rate of adoption was, and we had to work through some things like, the rate of which we could do installations, because that turned out to be a bottleneck. We had to do some work around that. There was math around figuring out installation procedures, but we got through all that stuff. And one of the things we did is we looked around geographically to see where our customers were. And one of the things that we learned that was really important was that our customers were in more dense areas. Think of it like, so if you think of the model, the model for WildBlue was sort of, they call them as like sprinkles and donuts, is that if you went around a metro area, what you would see sort of in the outer loop, in the farthest highways around that metro area, that's where customers would tend to be clustered, and then there'd be some sprinkled within. But what we found was, as we increased our value proposition, that is, instead of 1 megabit a second, we could do 10 or 12, and we could give people more bandwidth. We found that those customers, that the distribution of them skewed more towards the center of those metro areas. and it was very noticeable. And but the other thing you found is that, which is again pretty predictable, is over time between Viasat 1 and Viasat 2, that value proposition grew stale in some ways. And really what that was because of two things. One was the amount of bandwidth that would seem like a lot to a customer evolved over that time because the bandwidth demand was growing. And then also think of it as the alternative value propositions that were available to customers were improving, generally from metro centers on out, right? Because that's those terrestrial ones, their value proposition depended a lot on geographic density. So what we could see was, hey, that this is, it's not a point solution. It's like it's an evolution, right? Is that what you have to do is predict several trends. What are the trends at which we can improve our productivity? What are the trends in which bandwidth demands? What are the bands increase? What are the trends in which alternative value propositions improve? And the intersection among all those three trends would give us a good sense of how competitive our offer would be and where. And so with Viasat 2, one of the things we did is we were very focused on improving productivity, that is getting a lot more bandwidth for the same amount of capital. And then the other big thing was this geographic thing, because what we were finding before, and this has always been the case, still is the case in wireless transmission of any kind, is that in the places where there was high demand, there was a lot more demand than bandwidth. And in the places where there was low demand, we had too much bandwidth and not enough demand. And so you'd end up discounting in some way. I think of it as, okay, the market value of the bandwidth in those two markets is different. And so you'd have to adjust to that. So it became really evident to us that one of the really valuable things was being able to move the bandwidth to where the demand was. And then the other thing that happened during that time interval between Viasat 1 and Viasat 2 is we were able to, we had expected that we would be really effective in the in-flight market, because compared to the satellites that were being used for the in-flight market, we could offer a really good value proposition. So we did. And one of the things you learned in the mobility market was, wow, there's geographic variations in demand there as well, right? Because of where the main airports were located. So that was the big push on Viasat 2. We wanted to learn how to do that technically. And then we also wanted to find that, that hypothesis was correct. And it was. And so that reinforced kind of what we're doing on Viasat 3 as well.
And now a quick word about our sponsor. Before we started using the Tegas platform in 2017, CoStreet rarely used expert networks to find high-value sources to help us better understand the companies we follow. The competitors' offerings were expensive and limited. Tegas changed that dynamic through their innovative business model, allowing firms like ours with a more limited research budget to conduct expert calls at a fraction of the price of others. Tegas then records, transcribes, anonymizes, and posts a transcript to their platform for subscribers to learn from. Every new Tegas customer makes the platform stronger through deeper and richer transcripts, and I've personally seen the growth over the past 4 years. The Tegas network of experts and platform of previous calls has made the service an indispensable part of our investment process. In fact, we now use the word Tegas as a verb. If you haven't tried Tegas before, I highly recommend going to tegas.co for a free trial and to start Tegasing your research. What's really interesting to me is as I think about the move from, you talk about math being so important and the value proposition of providing the bandwidth. I'm interested to hear how you went from the idea for Viasat 1 looks really good on paper, given what we know about demand, towards we're actually going to build this thing and compete with existing satellites like that. For this company, we could have found a bunch of different pivotal moments, but I'm interested in that, like, go or no go decision. What puts you over to say we're going to try to develop our own high throughput satellite versus, continuing to, purchase other people's old satellites or something like that?
Yeah. So that was probably the biggest pivot point in the company's history. And we, it may have looked sudden, but it took us several years to be able to come to that conclusion because it was such a big change. And the biggest change for the company was that we were a capital light company. I mean, the whole company had been built on the value proposition of outsourcing everything that was capital intensive. And one of the things that people ask now about, well, when are you going to be free cash flow positive? We were very free cash flow positive before we did this, and we were very aware of what the implications were. But what was going on was we've been profitable. We've been profitable virtually every year, since the company's run. And so one thing that had happened was we had accumulated probably $150 million, and we were generating a bunch of cash. So we had a lot of money in the bank. We were generating a bunch of cash. And so one thing that happened in that time frame was it was possible for us to do that without taking an inordinate amount of debt or leverage. Okay. Just because it was possible didn't mean it was a good thing to do. Okay, just to set that aside. But when it was impossible, it was less important to explore those things. So the thesis, when we won WildBlue's business, we became their infrastructure provider and their terminal provider. We were competing against companies like Motorola, right? That was, and remember, and this was a time when Motorola was probably considered the most successful wireless and broadband company in the world, right? So the way we won is we were really focused on WildBlue, and it was because the value proposition of WildBlue was we're going to build a 7 gigabit satellite when everybody else has 1 and 2 gigabit satellites. And they seemed to be focused on this same value proposition that we theorized was important. And you have to go back, when broadband first appeared, there was a lot of question about what the value proposition was. And for us, it was just, it's all about cheap bandwidth. I mean, that's one way to put it. It's about making the cost of bandwidth a lot lower, because back then T1s were $1,000 and you could buy a cable modem and get a cable modem service for less than $100. And that's the value proposition. It was about low cost bandwidth. Other people were really fixated on, no, broadband has some other value. And so there were programs going on to both terrestrially and otherwise to make, there's frame relay, and there was all these other things in the terrestrial world. There was Spaceway and Astrolink in the government, in the satellite world, which were really about sort of managed bandwidth, but not about low cost bandwidth. So one of the things we wanted to learn from WildBlue was, hey, is this going to be successful? It was successful in the market. And so then their economics really were driven by customer acquisition cost. And we felt, no, that's not right. That might be true, but if you're going back to this escalation of demand, if you don't meet that, your acquisition costs aren't going to matter because you're not going to acquire customers, right? So we went round and round with them on that, and we weren't making progress. And they were also, their main thing, they were selling like gangbusters at the megabit type speeds, but then they seemed to be very concerned about WiMAX. Going back, this is in the 2005-7 timeframe. If you remember WiMAX, it was like Wi-Fi on steroids. Which made no sense. WiMAX was sort of an open version of LTE. Is really all it was. And while it was kind of good for some like equipment makers like Google and Cisco, it wasn't good for the carriers, because the licensed carriers, because they had all this investment in the telco-based stuff. So LTE, which was really pretty much the same as WiMAX, ended up being the value proposition. But the economic performance of the two systems were pretty much the same. We could figure out what the trajectory was. We knew that there'd be an opportunity for a satellite to compete with that, and it wasn't going to take away the market. So WildBlue didn't see that. So we went to their distributors, and that was Dish and DirecTV, and said, hey, if we could do this, would you carry this product? That was really what the question was. Would you distribute this product? And it was kind of a no-brainer. It's like, okay, right now you're selling 1 megabit, satellite broadband for $50. Would you sell 10 megabit satellite broadband for $50. Okay, yes, right. And because, so when the way the deals worked with WildBlue, and this is kind of, we'd set this up, is WildBlue didn't want to own equipment. So we had contractual relationships with Dish and DirecTV. They knew we could perform. They knew that we had built the infrastructure. So the only thing that was left was, could we build the satellite and make it work, right? That was it. And so we spent a lot of time on the satellite design. We worked with several satellite manufacturers. We went through the theory. There was some new theory of operation. We went through all that. We got patents on it. And boy, everything said it would work. We spent like 2 or 3 years debating this and researching it. And then we went through these steps where, okay, well, how do you get a license? We needed an FCC license. We needed an orbital slot. So we went through these things. We told investors that we were doing them along the way, not so much because we were committed, but because we wanted the option to do it, right? So all that stuff fell into place. We had to create some new regulatory environments around getting the spectrum that we wanted. That all was successful, and everything just lined up. So it finally came to the time when it was like, okay, are we going to do this or not? And we went through it all with the board. It also, one of the other things that also helped was, at the time, was the founder of WildBlue had left the company. He'd kind of, he'd been an entrepreneurial founder. They brought in professional management. He was excited about what we were doing. So we had him speak to our board. We had investment bankers speak to our board, just to go through, here's what the issues are, here's what we should anticipate. And we decided to do it. The thing that turned out to be the unexpected thing was, we started January of 2008. So we had $150 million in the bank. We had really good cash flow. We knew it was a $300 million project. We were counting on that cash flow, and also on the fact that we could definitely raise debt. And then all capital markets seized up for 2 years, but we still made it through. I mean, that was the one thing we didn't count on, was the capital markets closing even to good credit risks.
That's a really interesting history lesson. Let's fast forward a little bit, because I think people are going to be really interested in what's going on currently. So I think a lot of investors assume that the satellite broadband market is going to be a winner-take-all market. So kind of like how Facebook dominates social networks, or how Google dominates search, there will be one player who takes the majority of the satellite broadband market. Can you talk about that idea and about why there could potentially be multiple winners over time?
Yeah. So, I'm a voracious reader of business theory and understanding sort of general business dynamics. So the examples that you gave and that have turned out to be true in winner-take-all markets all benefit from network effects. And a simple way to state network effects are, the more customers you have, the more attractive your service is to new customers, right? That is the value proposition. So, and those almost always depend on multi-sided markets. So if you think about Google and search, the more search users they have, the more attractive they are to advertisers. More attractive they are to advertisers, the more money they get, which means that they can invest more money in search, and it basically creates this virtuous circle. If you think about Uber, the multi-sided markets are drivers and passengers. Now, the Uber one's a little complicated because you've got Lyft in there, which is a very similar one, and the switching costs are almost zero, right? For both the drivers and the passengers. So that's a moderating effect. But this idea of network effects, which is, if I have 1 million customers, I'm more attractive to the 1,000,001st than I am when I have 100 customers. Well, broadband service is the opposite, because what you have is a finite inventory of bandwidth, right? And all your customers' concerns are about is, how many other people do I have to share my bandwidth with? Even, if you take the best infrastructure in the US, and it's probably like, think of cable, good infrastructure, Comcast, Charter. The biggest problem that people have with those networks in the peak busy hours when people have to share their bandwidth with others and the network slows down, right? So in an environment where the demand for bandwidth is constantly growing and the demand is greater than the supply, it's the opposite of network effects. Is if you get too many customers, your service slows down, right? So that is the balance that you always have to go through, which is, well, how much bandwidth should I allocate per subscriber in order to make a value proposition that's good enough to pull customers away from whatever their other alternative is? And so if that's why I say it's all math. I mean, what you want to do is you want to figure out, okay, for any particular system, and we went through this, to great extent when we were first deciding about doing Viasat 1 compared to WiMAX or LTE, which is, well, how much bandwidth can they have? How much can they have per unit surface area? How many customers could they serve with that? How many people are there? What's our value proposition going to be? So we go through that same thing whether we're competing with another satellite operator for a specific market, or whether we're competing with a terrestrial operator. Now, there may be businesses that you can build on top of a transmission service that do have network effects, but the transmission service itself does not have network effects. Does that answer your question about that?
Yeah, I think it's a very, very articulate way of explaining that market.
Okay.
And so the other thing that we hear from people is, okay, well, fine, that may be true that there are going to be multiple winners, but the winners are all going to be in the LEO space, which LEOs are low Earth orbit satellites that are being deployed by the thousands right now by companies such as SpaceX. And on the other hand, people like Viasat have focused more on the GEOs, which are geostationary satellites that sit at a much higher orbit and are much larger than the LEOs. So I think within all of that, like there's this LEO versus GEO debate, like which one should you be? And then there's also this idea that, someone has to focus on just one. You're either LEO or GEO. So maybe talk about, how the world could evolve where there's people have hybrid networks or even partner with each other. How do you think that plays out over time?
Okay, so one thing, there's multiple dimensions that I'm going to try to unpack. Okay, so one question would be, look, if there's multiple orbits, why would you have hybrid? And the reason you would have hybrid is, well, if one orbit's better than another, okay, in some dimension of value, right? So let's just hold on to that for a second, okay? And you can certainly see examples of that. Let's just take terrestrial wireless as an example. Look at terrestrial wireless. There was this huge frenzy around millimeter wave, right? High band wireless, because that's going to deliver gigabit speeds. Well, yep, it does. It can deliver gigabit speeds for about 100 feet. Right. I mean, that's so. If you look at what happened with these, Verizon deployments of, ultra fast, you don't hear a whole lot about that today, right? But what would happen is, if you were under a lamppost where there was a 5G thing, you could sit there with your phone and you could download something at 400 or 500 megabits a second. But once you got out of range of that thing, it didn't matter anymore. And it doesn't mean that high band's not valuable. What it means is, really high speed, very short range. Low band, lower speeds, really broad range. Mid-band, right? Mid-band will have sort of a compromise between them. And so what you're seeing is people build hybrid networks out of that. Now that's spectrum, not orbits, but the issues are really kind of similar. It's propagation range, it's spectrum availability. Those are the things that determine different value propositions of the different bands. And there's no reason that somebody needs to be restricted to only one. You're not going to see a carrier say, I'm going to be a low band carrier only, or I'm going to be a high band carrier only. There's clearly benefits to having all of them. So what you should be looking for when you think about a multi-orbit strategy are, what are the ways in which these different orbits have different value propositions, and is there merit in combining them? So there are, the most obvious really good thing about LEOs is latency, because the propagation time is less. The distance is shorter, propagation time is less. So, okay, I'm going to definitely give that a check mark for here's a unique value proposition for LEO. The other one that could be true, depending on your orbits, is polar coverage. Okay, because if you've got a GEO at the equator or even a MEO at the equator, you can't see the poles. Now, if you have a highly inclined LEO system, you can't see the poles either. So certain LEO orbits are good. So actually, one of the things that's really interesting is if you look at, let's say, what Starlink is doing compared to what OneWeb is doing. OneWeb is purely polar or orbiting. Amazon Kuiper is purely inclined orbit. SpaceX has some of each. So in some sense, that's a multi-orbit strategy where the polar satellites actually have way lower utilization in the latitudes where most of the people are, but it does give you polar coverage. The inclined orbits have way more, they spend more of their time in places where there's people, but they don't have polar coverage. So even within LEO, that's still a multi-orbit strategy. The big problems with LEO are the geographic distribution of bandwidth. So if you look at you can't make a satellite at low Earth orbit look like it's staying still in the sky. It's going to constantly go around the Earth. And the problem is, it's like 95% of the people live on 5% of the land, which is about 1 or 2% of the surface of the Earth. So the analogy would be if somebody went to Verizon or AT&T and said, "Wow, we've got a super low latency, really cheap way for you to set up cell towers. The only thing is you have to distribute them evenly across the entire U.S." They say that's ridiculous. Of course they wouldn't do that, right? Because only a small fraction of them would be useful. So that's a big problem with LEO. And think, one of the best ways to think about why that's true is to use inductive reasoning. Okay, so think of it as, and this is exactly what happens is you build a satellite network, and this is what we did. And you look at, okay, where's the demand? And what you find is a big dynamic range of demand. So what we would find is like in Ohio, Pennsylvania, Texas, tons of demand. Montana, Wyoming, way less demand, more rural, but way less people. So what we did with Viasat 1 and Viasat 2 is we put way more bandwidth over those areas, okay? And we could do that without having to put more bandwidth over Wyoming and Montana because the satellite's stationary, we could aim it there. So now imagine I've got a LEO system and I'm going to do it on a big scale. Hey, I've got tons of bandwidth over the United States, tons of demand over the United States, or tons of demand over Germany or wherever it is, and no demand over the South Pacific Ocean. Well, I want to put up more bandwidth over the US. Well, that satellite, I put up one more satellite, 1% of that satellite's time is spent over the US. A fraction of a percent is spent over Germany. All the rest is spent over places where I already had excess bandwidth, right? So the marginal utility of that next satellite is driven by where it's covering, okay? Well, if you do a GEO satellite and you find, hey, my highest demand areas are the places where I want to put all my bandwidth, I can do exactly that, okay? So the way and then the other really big thing that people are coming to grips with now is scalability of the systems. So one of the things you have to think about is in an environment where per capita demand is escalating by around 30% a year, you have to think of it as I need 30% more bandwidth next year than this year. Okay, how do I get that? Well, one way is say, oh, don't worry, I'm just going to keep launching more and more satellites. Or the other one is, okay, I'm going to make the satellites I do put up have more bandwidth, which is, you can do both of them. It's not either or, you can do both. The problem that you have with low Earth orbit is that there's a congestion problem. You can only have a certain amount of footprint in space. And the footprint isn't necessarily, don't think of it just as a satellite, you have to think of it as what is the physical size of that satellite. And it's like, cross-sectional area or equivalent. You could look at it as equivalent sphere. What's its largest radius and figure out what that sphere is. But that's what determines collision probability. The mass of the satellite determines how big a collision debris field that I create. And all that debris, not all of it, almost all of it accumulates. Some of it may be sort of dispersed downward and decay in the atmosphere, but the debris that doesn't decay very quickly can be up for decades or centuries. So you end up with these limits to scale. Okay, in GEO, you have a couple of advantages. One is the volume of space at the altitude is enormously larger, and the protocols for separating the satellites are really well understood. You have to remember at geosynchronous orbit, all the satellites they're all going really fast, but they're all going at exactly the same speed. That's what keeps them in phase and makes them look like they are stationary. So their relative speed is essentially zero. Okay, so they won't collide with each other. At LEO, when you start inclining these orbits, you've got things moving at 15,000 miles an hour, and they're all intersecting. They're constantly crossing at actually relatively short distances. And whenever you try to maneuver a satellite to avoid one thing, you're creating more of a chance of it colliding with something else. So the statistics are, and this is, I think that this is the thing that people need to understand is there's a bounded capacity in LEO. And the other issue is that people don't understand quite so much, and it sounds a little bit weird, is if you think about, okay, so it's technical again, the way that you get bandwidth on a wireless system is through flux density, which is basically, it's a measure of the electrical energy that you have over an area. So it turns out that the amount of electrical energy you need to generate from a satellite to cover a given area on the ground is exactly the same no matter what altitude you're at. Okay, and that's because what happens is you at either altitude you need an antenna aperture that focuses the energy over that area. So no electricity goes away. It's only a question of how much it's dispersed. So I need a bigger antenna at GEO, but if I can get an antenna at GEO to make the same size spot on the ground as at LEO, I use the same amount of electricity. Well, that's important because electricity comes from solar panels, and the solar panels are the things that determine that cross-sectional area of the satellite. So think of it as if I go to LEO and I say, hey, I'm going to make a satellite that's got twice as much power, it's like I put up twice as many satellites. So whereas at GEO, I've got both dimensions to work with. I can make really big, I can make really high power satellites, and I can put up a lot of them. And the more I focus their bandwidth, the more I can put in the same slots. So from a scale, so GEO is far more scalable than LEO. That's the main point. So now you've got some of the ingredients that you can use to say, why would I have a multi-orbit strategy? The reason I'd have a multi-orbit strategy is I want to drive down the cost of bandwidth. I want to put it in specific locations because the dynamic range of demand is very, very wide. And if I'd like low latency, I can use the LEO for that. Then the other thing you'd look at is, okay, well, what's the demand? What applications demand low latency versus what applications are latency insensitive? And by far, the dominant use of the internet is for video, which is not latency dependent. Okay, so people may be sensitive to things like, okay, hey, if I press play on a movie, how quickly does it start? And people can tell the difference between a tenth of a second and a second, right? So okay, what I might want to do, and this is what we do is we'd say, okay, hey, let's put the first few seconds of a video through a low latency channel, but we'll put the predominant, most of it through the high latency channel. Or if people are doing channel surfing and they're doing live, hey, every time they change channels, we'll put that over a low latency thing, and we'll put the bulk of it once they're set on a channel, we'll put that over a higher latency one. But what you find is you probably only need 5-ish% of your bandwidth to be low latency, which works out well because that's going to be a lot more expensive bandwidth because the supply is limited. So now that's basically the reasoning behind why you would have multi-orbit, why you wouldn't say, I only want, just like you wouldn't say I want all low band or all high band, I wouldn't want all LEO or all GEO, but you can figure out, I'm just going to give you an example. If you look at what's going to happen in the 5G world, in a high band, low band, mid band world, what you find is low band is going to cover most of the territory, but high band and mid band is going to carry most of the bandwidth, right? So in this case, it would be sort of the same thing. Low orbit will carry all the low latency stuff. High orbit will probably carry the bulk of the bandwidth.
Got it. And so, yeah, you make a pretty compelling case why a hybrid network is probably, from a consumer's perspective, probably the best solution. Let's move to the defense side a little bit, because I think it's another part of your business that people maybe don't talk quite enough about. So you have a defense side and then kind of a more commercial side. And these businesses, they share common assets and infrastructure, but the end markets are very different. And we talked about this a little bit, but I'm interested about the culture of those things. Are there two distinct cultures at Viasat, more of a commercial one and more of a defense one? And if so, if there are differences, how do you maintain a cohesive culture company-wide?
Yeah. So I'll tell you the most striking difference between defense and commercial comes in, if you think, I like to think about markets, okay? And so what's the most striking thing about a defense company, and it's less true for us, and I'll tell you, this goes to how we make the cultures compatible. But the way the defense industry generally works is the customer, whoever, some acquisition organization says, I want to buy X. And what they do is they come up with very detailed specifications. I'm going to buy X. I need proposals from multiple contractors. I need to compare them. They all need to propose exactly the same thing. And then I'm going to choose the best, either the lowest price or the best value. And then the job of the winner is to make X. Okay. And generally, those are multi-year programs. And one of the biggest problems the defense industry has is from the time they started building X until the time the project is done, the environment may have changed completely, and X isn't really very useful anymore. But doesn't matter. The customer is going to buy X. And that customer, like if you look at congressional oversight, like one of the biggest ways that defense acquisition organizations can get in trouble is they say, I want to buy X. And then 2 years later, they say, oh, no, the market's changed. I want to do something else. Well, wait a minute. Your budget's changed. You didn't know what you're doing. I mean, there's enormous pressure on the defense acquisition organization to not change and to do exactly what they contracted for. So from an engineering perspective, it's like, oh, hey, this is pretty interesting. I'm going to go work on this project. I know exactly what I'm going to do. Nothing's going to change. I can do that thing. That's all I got to do. Head down, make that thing, whether it's useful or not. Okay. Well, in the commercial world, if the market changes, you're building something, and if the market changes, no sane commercial company is going to say, well, hey, I started building this thing and I'm not going to change even if the market's changed. So what you end up with, you can culturally, is these two different environments where on the one hand, you've got engineers that are very focused on building exactly this thing, customers that are only going to say, nope, you got to do exactly what we said. It's like this insulated bubble. Okay. On the other one, it's like insanity. It's like, hey, what's going on in the market? Am I reading the signals correctly? What are my competitors doing? Did somebody come out with something new that's going to either make my product this attribute more valuable than that one or change the balance? That is, I would say, that's the most striking thing. And we'll have when we have programs that are government run like that, we will have engineers who have had a rough time in the commercial market where things are, constantly evolving. And it's like, it's a very complex environment. They can go to like a government program and say, wow, oh, this is easy. This is like easy. Okay. And it's not the real, they realize one is it's not the real world. And then the other thing that they tend to realize after 3 or 4 years is, well, this is kind of stupid. It's like, hey, I'm building this thing for this environment. The environment's not there anymore. It's like, why am I, it might be easy, but it's not rewarding, right? So you can have people go back and forth. But what does work at our company is this thing I kind of alluded to at the beginning, which is there tends to be a big gap between the acquisition organization that has all these oversight requirements and the actual fighting organizations that are getting shot at, right? It's like fighting, if you're getting shot at, you don't really care what the acquisition rules are. You don't care what your congressman thinks. It's like, hey, no, I better do these things or I'm going to get killed or my friends are going to get killed. So I need this, right? So think of it when you talk about going through distribution, right? The things we talked about in the commercial world, those same things exist in the government world. And what's happened, especially, after the U.S. being in these conflicts for 2 decades, is the fighting organizations have, they've become very sensitized to the problems in the acquisition world. And fortunately, there have become mechanisms where the actual operating organizations can acquire things themselves. So the parts of the defense industry where we really shine the most are in dealing directly with those end users and dealing with the threats that they have. And a lot of that is around information. It's like awareness of what's going around them and ability to employ all the options that we have. And a lot of that's communications, computation, sensor fusion. Those are the areas that we really shine.
So you started to go down the path of the future of warfare and what your customers are looking for on that side. I'd love to hear, your thoughts on what the future of warfare looks like, and then how does Viasat 3, that constellation, play into that strategy?
Yeah. So I think that the probably one of the most striking things about warfare now is pace, is speed. It's like the rate at which things happen. So, a lot of what we've done since the Iraq War is really dealing with terrorist organizations. There are, now there's kind of, these near peer threats. And you look at, what did we do? Like in the first Iraq War, we spent months building up for a land invasion, right? I mean, literally months, bringing tons of people and material. So it was like war in slow motion. That's not going to happen anymore. Everybody understands that. So what's going to happen at high speed is really 2 big things. Number one is figuring out what's happening, is because if you look at what's happened, what generally happens in all warfare is one of the biggest factors in it is deception. It's like, you look at it's like, hey, the enemy thinks we're going to go there, but we're really going to go there. How do you create that? And usually those impressions are created over long periods of time. Now they may be created over seconds or minutes. That's all the time you're going to have to decide things. So what we think are the really, really important things are going to be is, number one is aggregating enormous amounts of sensor information, because especially think of it in a cyber world, one of the most important things is you're not going to be able to trust all the sensors. You're going to get conflicting information. So you'll have, what we call national assets, which may be space-based and have very large fields of view, may give you certain types of information to high fidelity. Then you'll have local assets. You'll have lots of different sensors, all of which you have to integrate to try to figure out what's actually happening. And you'll need to be able to put that all together in data centers, run AI type algorithms with machine learning algorithms on them, identify all the inconsistencies and say, okay, they're doing this, this, and this, but this is what really matters. And you're only going to be able to do that by fusing lots and lots of sensor data. Then once you figure that out, really quickly, you're going to have to respond. And that's going to mean, and you're seeing all these things now, it's like standoff weapons. How can I make weapons platforms effective from hundreds or thousands of miles away? How can I convey all of the information that I deduced from all these sensors to the actual shooters. And then what you may end up with is the people that released weapons, who may be hundreds or thousands of miles away, are going to want organizations that are closer to where the battle is to direct those weapons. And in real time to say, hey, I've already taken out this target. Now let me go to those targets. Or nope, I didn't take out the target I meant it. Now let's redirect those weapons that came from a long way away. So all that is very, very dependent on communication, right? It's how do I get information into the cloud? How do I aggregate it all in the same place? And then how do I disperse it to all the fighting forces over very large areas? And you're gonna have to be sure that one is that you have the reach to do that, and the other one is that you're robust to countermeasures, that the adversary can't prevent you from connecting all these things, because it's the connections among all the things that make you effective. So Viasat 3 is really suited for that environment. Number one is the security of the ground infrastructure is very high. And we do that by having a highly distributed and virtualized system. So in most big satellite networks, there are distinct nodes that if you take those out, you can take out the entire system. There's no such thing in the Viasat 3 network. That's one of the things that's really unique about it. The other thing is that we can reach anywhere in the world. And it's pretty much true, even for a geosystem, for airborne types systems. For things that are on the surface, we have a little bit of gaps in the polar areas where we will use multi-orbit. But otherwise, we can see pretty much anywhere in the world, and you can reach them from safe havens in every part of the world. In each third of the world, there are safe havens that we can reach them from. And those are safe in the sense of physical, cyber, and having the computational resources that you need. And then the other really big thing is, if you look at the factors that determine jam resistance or resistance to other countermeasure threats, Viasat 3 is it's better than almost any other defense system. That's because the same things that allow you to handle enormous amounts of traffic allow you to deal with very large countermeasure systems. So those are the attractions to it. The other thing is that in a wartime environment, what you'll find out is, okay, I don't know where I'm going to be, but wherever, I'm just going to pick an example. Aircraft carrier group could be anywhere in a very large, ocean region, but wherever that is, I'm going to need a ton of bandwidth. Right. So the idea of being able to, again, geographically concentrate large amounts of bandwidth in an unpredictable location is also going to be really, really important there. Okay. So those are a lot of the elements that we think are going to be needed. Now, the other one that right now people are concerned about in space is anti-satellite weapons. And so one of the things that's really interesting about Viasat 3 is it's a commercial satellite system. So we think that if you compare it to government systems, it probably costs about a quarter or less of the cost of what would be considered kind of a exquisite defense satellite system. So not only does it have all these capabilities, but you can proliferate it. You can have a bunch of them, and you can have enough so that you can be resilient against space-based attacks as well.
There's clearly a lot of interest in space right now overall, right? Like, just look at Blue Origin and Virgin Galactic, look at Elon trying to go to Mars, and the US now has a Space Force. I'm interested, you're not going to play in all of those things, but I'm interested in how Viasat can be positioned to support all of these people who are spending hundreds of millions, if not billions of dollars on space assets.
Yeah. So, one of the things that already has become important is communications among all the different space assets. So that's one of the most interesting opportunities. And the communications among the space assets, basically think of it as, okay, I'll give you one example, and the one we just gave is, let's say I'm looking for something in the ocean, and I want to find that, and I need to be able to to transfer what I learned to someplace else right now, right? I can't, it doesn't help if they find out about it's 4 hours from now or 6 hours from now or tomorrow. So there you've got one space asset that has no ground station in view and needs to get information to another space asset. Okay, so think about you need to remember, think of this as there's in two environments. One is homogeneous, that is, hey, I built a constellation, that constellation can communicate with itself. Okay, fine, I can do whatever I want, custom. But what really becomes valuable is when a whole bunch of different constellations can communicate with each other. So, right, so for instance, and you can see this coming, right? And we've had this for decades. I mean, NASA had something called TDRS, a tracking data relay satellite system, which was a way for some satellites to relay information through this TDRS satellite back to any place else on Earth. So there's commercial needs for that. Like one example would be Wildlife Conservancy is concerned about overfishing in areas. If somebody's overfishing in an area, they want to know now so they can interdict and not know tomorrow, right? Same thing you can imagine in a defense environment. So what you want is, you might want that for a combination of sensors. You might want radar and video and still imagery and infrared, right? You might want multiple ways to confirm, hey, what I'm seeing is what I'm seeing. I'm not being spoofed. It's not cyber. I've got multiple ways to do that. So this idea of heterogeneous inter-satellite connections or an internet in space is kind of big opportunity. So there's a couple of different ways to do it. One that some organizations are really excited about is lasers as a way to do that. One of the big problems with lasers is they have to be very, very stable, and they take a while to set up a link whenever you set up a new link. Another way to do it is with really, really high frequency radio, which is basically what Iridium does, and a bunch of government systems that are using radio links. The good thing about that is it's really more like the internet. It's a packet-based system instead of a circuit-based system. I can hop around and talk to any of many different satellites, and I can relay through a bunch of different nodes. So that's one of the areas that we're really interested in. We did that for Iridium. So for instance, we did the Iridium inter-satellite links. We're doing inter-satellite links for the new GPS system for the government. We have a number of other programs around that. So that space-to-space network is a pretty exciting opportunity. And you can imagine as people put up, whether it's manned or unmanned probes or sensors or do things in space stations in orbit, what they're going to want is to collect a bunch of information through networks. And that's kind of what we're aiming for.
It sounds like it's just the amount of money being spent there and the core assets that Viasat have are like just fit pretty well with where the world's going. I'd love to ask a quick question about your largest shareholder, who is Seth Klarman from Baupost. He's been a large Viasat shareholder for years. I'm curious, anything that you've taken away from that relationship, either about capital allocation or about how investors view the companies. Like what have you gleaned from Seth over the years?
Well, the main thing is, he's a value investor, right? I mean, what he's looking for is value creation. So everything, when we interact with him, it's okay, what is creating value, and what is the company doing to create value as opposed to destroy value? Right, and how much of it is fundamental and realizable, and what are the things? Can you distinguish the things that you're trying to do that create the appearance of value versus really create value? Right, that's what it always comes down to, and he has a time horizon which is long, but he wants to know that you're creating value and that you're doing it the most effective way possible, right? And the other thing, that he's looking for are, okay, well, are you like pushing the envelope from a financial and economic perspective, right? There's always, his book was about margin of safety, right? So it's like, okay, you want to create value, but you don't want to take inordinate risks in doing that, right? So how are you balancing those risks? What risks can you live within, live without, and try to incorporate the cost of risk in your value creation, right? Which is kind of that's very appealing to me, because I'm so mathematically, inclined is to try to quantify things. And so, you think about, gambler's ruin type things and Markov processes, right? Those are the things that you'd want to think about when you're taking risk and trying to create value. And I would say Baupost, they're a rational investor. They're very concerned about stock price, but I think it's always, okay, why doesn't stock price follow value creation? And if the market, the other questions that they're always asking are, hey, if your stock price is mispriced in the market, why is that? Why do you think that is? Are you doing things to deal with that as well? Right? Those are the kinds of questions that they ask, and I think they're all really good ones.
Sticking on the idea of communicating with shareholders, so you're going to be launching 3 satellites over the next few years, and you've put out this 2025 guidance that includes a doubling of revenue and EBITDA, and anticipates a fair amount of customer acceptance of your offering. So you guys talk about 3 keys to achieving your goals, but I'm interested in how you can be confident enough to put guidance out there, when the satellites are still on the ground. Talk to me a little bit about the elements that are kind of already in place that give you confidence about being able to hit those 2025 numbers.
Yeah. So the thing that we're looking at are the market, and the big thing on the market is let's say remember we have multiple different business areas, right? So we do things like Earth observation antennas, we do tactical data links. But a big part of our business, a big part of the growth is going to be in the broadband connectivity space. So the thing that we're really looking at is market value of the bandwidth. Okay, so if we have a transmission resource, what is the value of that much transmission in different market segments and in different geographic areas? And you can figure that out, right? You can look at it today. You can say, okay, what are people paying for transmission? And one of the things we found, one of the things we were looking for, like with Viasat 1 and Viasat 2, was how does the market respond to these? And one of the things that we saw with Viasat 2 was delayed a little bit. And one of the other things that happened was that eventually AT&T and Verizon decided to match T-Mobile in unlimited plans, which weren't really unlimited. But what that meant was there were way more terrestrial customers who could buy bandwidth by the gigabyte, and they could see what that gigabyte price was. And what we found was, well, hey, in the places where their gigabyte price was lower than ours, we lost customers. In places where our gigabyte price was better than theirs, we would gain customers, right? And it was, hey, the market's acting rationally. It doesn't do it instantaneously, and it doesn't do it on a point perspective. But if you can find over a big market, yep, there's a market value to that bandwidth, and you can measure it not only by the things you do, but by the things other people do. So that's what we look at, is in each of the markets, well, what are people paying for bandwidth? And then what are the trends in those things? And so one of the things that we look at is, where are we competing with terrestrial, that's challenging, but it's doable under the circumstances I described. And then the other one is, where are we competing with other satellite services? And in the other satellite services, really, we look at 2 things. One is, we've had plenty of times where other satellite operators have either misunderstood what their own costs are, or because they want to penetrate a market, will underprice the bandwidth in that market, right? And so, okay, a customer might make a rational decision to choose somebody else if they're pricing lower than us. But the other thing you have to look at is, well, how much of that bandwidth do they have? Because if they sell more than they have, their value proposition is destroyed, right? Because they're not delivering what they said at the price they said they would. So going back to all this, it's like, okay, we can look at what the market price is for bandwidth. We can look at what the other mechanisms are for creating bandwidth in the locations that we can create it. We can estimate what those prices are. Demand's not going away. It's only really a question of what is the market value of the bandwidth in that place, in that application. That's what the issue is, because there's enormous amounts of demand. It's really only what are the substitutes. So that's what we're really focused on, is understanding the alternatives in each of these markets. Is that I mean, it's like, hey, the demand for the thing that you're making is virtually inexhaustible as long as you're at the right price. So what you need to do is be able to anticipate the price of the bandwidth in each of these markets. And that's turned out to work. No, that's turned out to work in all of our markets. And it makes complete sense, right? At the end, if the customer understands what the value proposition is, and customers can be tricked. I mean, that's happened in the in-flight. You can see, like, there are a number of in-flight companies that have gone bankrupt because they misunderstood the market, mispriced their bandwidth, didn't deliver on the value proposition. I mean, sometimes it takes a while, but the markets always understand. Eventually, am I getting how much am I getting for how much money?
So, I mean, that's an interesting way of describing what sounds to me like mostly the consumer broadband market. And as we go to our last question, maybe you'll talk about this a little bit, but it sounds to me like what you're building with Viasat 3 and connectivity for the military may not be so. There may not be so many other competitors that can offer and compete with that. So maybe talk a little bit about that, and then any other aspects of this company that you feel like are maybe misunderstood or underappreciated by investors or people who are just approaching it for the first time.
Yeah. So, basically the way to look at it is, and when you talk about defense, it's like in every one of our markets, there's some alternative. Okay. There's some alternative, right? Like, for instance, if you're out in the middle, if you're in an oil rig in the middle of the ocean and you're trying to analyze what's coming back in your drilling activities, you might end up having to archive all the data and send hard drives back on a helicopter. But that's the alternative, right? So what we're trying to do is figure out what is the value of our alternative relative to all other alternatives for all of the vertical and geographic markets. And if we're selling to the military, there's a way different value to our bandwidth if it's used at a training camp in the US versus if it's used in the middle of the Pacific or off the coast of North Korea, right? So that's really what the challenge is to understand what the value of that bandwidth is. And then the other is, if you want to build long-term relationships, is to treat customers fairly, right? That's what I would say. You don't want to be overly greedy, right? That hasn't worked. That hasn't worked well, and we have long relationships. But that's the point about sort of how we estimate the market, is the market saturated? And it's not. And then, okay, what are the alternatives? And what we want is agility, so that in the event that, hey, there's a 9/11 or there's a pandemic that grounds airplanes, can we move our bandwidth into other markets where there's still demand? That's one of the other really big things that we're looking for, is that optionality and resilience. But the thing, to go to your, and so the point I was making is that approach of trying to understand what the market value is in all these different vertical and geographic categories applies across all of our markets, not just consumer. The other point about what I think is the most misunderstood is how mathematically predictable what we do is, right? That it's not like we sit around and dream things up, and it's like there is a math foundation behind all of it, right? You can figure out. I mean, you can read the specifications for 4G and 5G, and you look at how much spectrum is available, and you can figure out, oh, this is what they can do, right? This is how much bandwidth they can have. This is how many customers they can have. You can do the same thing with a MEO satellite or a LEO satellite. If you really understand the mechanisms behind beamforming and modems and channel capacity and radio transmission, all this stuff is really, really predictable. And I think one of the things that's a little bit interesting is, there are many investors and hedge funds that are super quantified about the way they invest. But what we think is, well, if you go to the fundamentals, what you really want to be is super quantified about the things you invest in. It's like, what are the fundamentals behind those? And it's very, we kind of like the fact that this is complicated because I think we're really rigorous about it. And I think it's worked. It's worked well. We're really pretty clear about, hey, bandwidth is about economics. And so here's the constraints that govern the economics that you can get under any orbit or under any spectrum, right? And we haven't even talked about spectrum as an example, where you have the same things that apply to spectrum trade-offs in terrestrial apply to spectrum trade-offs in satellite. So there's other dimensions of value that you can take advantage of. So that's the one thing, the one thing that we would wish for, is just more quantitative discussions about what makes our business work. And a little, sort of more in-depth analysis around that.
Yeah, I think there's this field of dreams perception where there's this like hugely speculative idea where, we're building this thing and just maybe people will come. And your point is that there's a lot more rigor behind that.
Yeah. Yep. And there are, the other thing I think that I'm going to tell you, one thing that's really interesting is that there's a saying. It's Mark Andreessen repeats it, but he credits it to Jim Clark, who is the Netscape, basically who worked with at Netscape. And he said, there's only two business strategies, bundling and unbundling. And that's really insightful. I mean, that's actually true. And what it says is, it's like vertical integration versus horizontal integration. You can think of like bundling, like Netflix is unbundling video from transmission, right? It's like all your entertainment came from a cable company, which was a transmission company. It didn't used to be that way, right? So now Netflix is unbundled transmission and content, as an example, right? And you can there's lots of examples where that's true. But what it really says is, there's two strategies. There's what you're doing and the opposite of what you're doing, right? That's what it says. And that you really shouldn't do the same thing over and over again. And the other thing that's really, really interesting is in an environment like that, both strategies are playing out at the same time, right? People are doing bundling strategies at the same time other people are doing unbundling strategies. And they're both going to find markets. And so the thing, that's the other thing that I think is what makes companies successful over the long term is agility. And sometimes it's doing the opposite of what they started with. And so that's how we think, right? We're always looking for that. And I actually think that's a strength, right? To be able to take that perspective and be that adaptable.
Well, Mark, we could probably have you on for a few hours because there are probably 15 questions I didn't get to, but this has been incredible. I mean, we've jumped around and we dug deep into the satellite economics and the technology, but also the different sides of the company and the culture. So I think people have a holistic sense of how you've built this company. So thank you so much for this time. It's been a really enjoyable conversation.
Sure, same here. I really appreciate it. Thanks for the opportunity.
That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast@covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.